Hello, everyone. Welcome to Quick Start Lab number 7. Hey, did you like my announcer voice, Corey? What do you think of that?
Yeah, that was your radio voice there.
In another life, I'd like to do the radio thing. Or you know what
Yeah.
I want to do? I want to like announce All-Star Wrestling or something.
Right.
I want to be the Let's Get Ready to Rumble guy, right? You know, you can't say that. You can't say Let's Get Ready to Rumble. Like I
It's
could be
copyrighted.
saying that. I
So if
think
I
I
say, oh, let's get ready to, then
don't
I guess
don't do it.
I'm gonna
Don't
guess
do it.
to it.
I've heard that dude will sue you. So I guess we can say it, referring to it, but we can't actually say it like if we
At an event.
wanted to be ready to rumble. If we want to be ready to rumble and we told everyone to get ready to do that, we couldn't say that. So
Wow.
anyway, hey, how's everybody doing? Let's see. Let's pop up the question box here.
Little Silver, New Jersey. How about that? Very cool.
No, New Jersey's the Garden State. Okay. It's live, not Memorex. That's pretty good. Awesome. In the house in Orlando, we got it going. We got a lot of Florida. We got Edgewater. We got Orlando. We got up north in Toronto, Riverside, California, Humboldt, Iowa. Fantastic. We got a couple Iowans. Paul's from Iowa City, and Kyle's from
Westboro.
Humboldt. Yeah,
Westboro,
Vancouver in the house, Washington, Germany, of course, Germany, Dallas, Phoenix, all over. Fantastic. I'm fantastic, just as Noah says. I'm fantastic. Noah always said. Noah should trademark that.
Oh, there's your favorite one, Alabama.
I love saying that, like Gene Hackman. What's the name of this vessel? Alabama. Okay. Good stuff. Hey, we got quick start number 7 coming on. We're going to talk about some details, little details that I think it's a good time in these trades to start talking about them. We can look at the Oxy trade, and the gold trade's doing well, and trades are just doing well, man. What can you say? But we got to disclaim, as always, it's about education. This stuff has risk to it for sure. And I've been bit by risk many times. And if you invest at any appreciable length of time, you'll probably get bit at some time too. But if you have some education, that softens the blow significantly. And you can live to trade another day and invest another day. So no advice, education, keep it on your paper trade account, will be just fine. With that, why don't we you want to check in on our trades and maybe why don't we just kind of do a review?
Yeah.
And okay, here's what we've been talking about. Here's what we've learned. I think we can start with this. Is you start with a market opinion, and our market opinion for this month has been that we think during the quick start labs take the whole month. And so for this month, we've said we think we're going to be neutral. I've said maybe a little to the bullish side, moderately, maybe. Of course, Noah's been more right than I have, for sure.
You called me Noah, but that's all right.
That's a compliment. But no, Corey was right. Well, Noah and Corey are both right more often than I am, for sure. But yeah, we've kind of had this. If you look at where the S&P is, you've kind of got some 4,300 level on the top, some 3,500 level on the bottom, and we're just sort of meandering in that little, kind of looks sideways to me,
Yeah, let's pull it up here. I'm just gonna pull it up on my screen, and this kind of speaks to it, right? When all your moving averages are bunched together and kind of sideways and whatnot, and you say we're at the same prices we were a month ago, and we're at the same prices that we were 2 months ago, and we're at the same prices we were 3 months ago, there's not a whole lot going on there from an S&P perspective.
Yeah.
So that's kind of
engulfing candle today.
Yeah.
So maybe we get some confirmation tomorrow. And
I'll tell you this, people often ask, what's your favorite candlesticks? What's your preferred signal? And most candlesticks are kind of not all that instructive, right? It's just another day and we don't make too much of it. But whenever I see, especially when something's been coming down, 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 like this has for a couple of weeks here, if I see either a long, long shadow candle, what we call a hammer,
Yeah.
or B, a bullish engulfing. So let's just keep drawing it out. And here's your bearish candle. See the red? And here's your bullish candle that engulfs or swallows that up. See this candle engulfing or swallowing that one up. Those two candle formations. So this would have most definitely grabbed my attention after a pullback. And this would most definitely grab my attention after this pullback.
Another reason this grabs my attention is we blow through the 200 and then we come back and we're actually testing the 200 with this bullish engulfing as well. And I don't know, I mean, do we have a lot of resistance, evidence? Not really. Some stocks you can really see a definite sticking point of support or resistance on some moving average. I don't know that applies here necessarily, but we'll see what happens. I mean, you've got here we go.
It hasn't used it perfect because it's kind of been a fake out, right? Like here, in fact, this was a day where I called it an exhaustion. If any of you are in our coaching program, we talked about that when you're. So let me explain it this way. Context around things matters, right?
For sure.
You can't just say that, well, this candle formation is great. You have to look at the context around it and say, well, where are we coming from? What levels are we at? What's the overall trend and so on? And this type of move, a lot of people will say, oh, this is a breakout. It's time to get in. But usually, if it's like this, where you've already extended a lot, you think about all the energy and all the buying pressure that you've used up to get to this point. Plus, what you can't see on this particular chart is that we came way down. Buying a breakout into a lot of overhead resistance like this, let me back this chart out so you can see it. And you'll see, I call this dead bodies. These are dead bodies just weighing on the market. So breakouts like that can't really be trusted. Here's the quote unquote, theoretical breakout above the 200. The reason I wouldn't trust it is, to me, here's where the race began. Look at this bullish engulfing down there. You see that massive candle? Kind of hard to see. Let me shorten this chart up just a bit further. Let's go, what would be an ideal time? Let's go 8 months. Let's see if that captures kind of all of it. Okay, here's this huge bullish engulfing candle. And this was what I would consider to be the start of the race. So something similar to it will often be the finish line. And if you think about a runner, when do you have the most energy? Well, you have a big jolt of energy or adrenaline when the starting gun goes off. And when you see the finish line, right, you sprint for the finish and you literally just use every ounce of energy you have. And that's what this looks like to me, because we've already run for a long time. Now we're getting up here. Now we sprint for the finish line. And we could already see on that prior chart, not only were these prices higher, but back here was higher and here was higher, meaning you have all this potential for resistance because all the people back here bought at bad prices, at higher prices than where we're at. So if we think about it from that standpoint, what's the potential resistance for this? Well, the potential resistance for this right here is literally all of this. Every one of these buyers bought at higher prices, every last one of them. That makes it really hard for a market or a stock to have strong breakouts, because as it tries to go higher, these guys want their money back and they want their money back and they sell their old positions and they sell. See how much selling pressure, what we call overhead supply there is? These are all these dead bodies, these bad purchase prices. that want their money back as they're made whole and break even and so on. So a breakout like this is just not, it's just not clean. It's not something that likely has momentum. And so I did a little quiz to our coaching students. I said, just this week, I said, which one do you think has a stronger breakout? Stock A, consolidating here and now trying to break out, or stock B? Which one has the potential for a bigger breakout? And a lot of people said A, and it's counterintuitive. You'd think, because they're anchoring to these prices and they think, well, it's a discount. It's a discount. It's got more room to run because look at where it was. But that's not really how it kind of works, because all of this is a headwind. It's like this big wind that's just pushing against you as you try to go up. Have you ever tried hitting a golf ball into the wind? It's hard. It doesn't fly as far. This one has no wind. In fact, if it has anything, it has a tailwind, right? Nobody has bought at bad prices, and anyone that sold in the past has only lived to regret it. So the supply is just not there. There's not as many sellers. Now, could it find some supply up here where people are finally, they say, okay, enough's enough, I'm ready to sell? Sure, and it will top out from there. But it's consolidated after a huge run. It just doesn't have any overhead supply. This is Michael Jordan. He can jump from the free throw line and he can fly. And this is Michael Jordan trying to jump from the free throw line, but you stacked all this weight on his shoulders. And it's just, he just can't do it anymore. He can't make it because there's all that overhead resistance. So that's kind of where the market is at in terms of the upside, is all these little attempted breakouts. You see how they're failing? It's not a huge surprise because you just have all this overhead resistance. Back here, when the market would break out, well, it'd take off because it was new highs, right? It didn't have that overhead resistance. So if you go back and you look at all these breakouts back here, okay, fine, perfect, great. When you're in a strong bull market, and about the only sector that I can really say is in a true bull market is energy, that's when breakouts fly, right? When you're in a bear market and then you try to break out, they're usually false breakouts, failures, and so forth. So don't get caught off guard by that. Now, this is a better way to buy the market because you're buying the dip as opposed to trying to buy that breakout. See this breakout failure? It went up for a day or so and then right back down. Not a great way to buy the market. Here's a much better way to buy the market as you're scraping and clawing your way. If you think you're clawing your way out of this bear market, you'd still much rather buy the dips than try to buy on momentum.
I'd like you to make a comment on the difference between investing and trading. And if you would, could you quickly sketch those two graphs, the one that had headwind where you kind of had a dip,
the A and B,
yeah, came up into consolidation, you dips, and then you get consolidation. And then you look at the one that has the tailwind and up like this. Now, this is an interesting, I like your comments on this. Let's say that you want to look at this from a standpoint of dividend and a standpoint of call writing. One of my favorite ways to invest is to find a stock that's cheaper and then find a stock that has a decent dividend. This is more of a trading idea where you're looking at where the price might go.
Correct.
Well, could you just comment on the difference in mindset on that stuff? Because often I wouldn't want people, like, let me give you an example. Bring up like maybe Intel or like 3M right now. So there's some headwind.
Yeah.
There's
for
some
sure.
But in the terms of price, this is not a short, there's a lot of headwind right here, and this is definitely in a downtrend. Look at the moving averages, all three moving averages. And remember how I said some stocks will hit their head on that moving? See how it's hitting its head on the 200-day?
Yeah.
Right there? But when I look at this one as an investment, I say, okay, is it going to stay here for 20 years?
Right.
Probably not. Great. I mean, your ROI on the dividend now, as long as they don't drop the dividend, boom, and you're always going to be able to write calls at $100.
Yeah.
Intel. Intel's losing cash, dude. Intel is like, if you look at Intel's financials, Intel has had its face kicked in. Okay.
Yeah, and didn't they just cut the dividend as well?
Yeah.
Had to
There's just,
slash
I
it a
mean,
little.
boom. But in my brain, I'm like, all right, the biggest problem Intel's had is market share. They have lost market share. So the question in my mind fundamentally is, does that continue, or is the worst over and they rebuild from here? Because now
Yeah,
you've got pretty low, so in a way you have to balance, oh, this is on sale. Well, I think you got to look at if they're on sale in terms of the price to the fundamentals.
exactly.
Okay, that's when you know whether on sale in relationship to how the business is doing, as opposed to say, well, here we go, this thing is bound to bounce. No, you could be in for a long wait with 3M. You could be in for a long wait with Intel, because fundamentally they're like, 3M's still pretty strong fundamentally. Intel, oh boy, they've lost market share and
Got some issues, yeah. And
yeah,
we always say,
stuff.
I mean, to your point, fundamentals, like if you were saying that all four pillars matter, but fundamentals really matter to the investor, right? I mean, that's where, because fundamentals are, they're something that plays out over an extended period of time, over a long period of
The
time.
high frequency
Traders,
traders don't care about the fundamental. Like if you're a day trader, fundamentals for the day trader. The
yeah,
smaller period, like the nanosecond traders, the high frequency traders, they don't fundamentals, whatever.
has no impact, right?
Yeah, the the long-term investor really cares. The position trader cares. The swing trader might even care, depending on if there's an earnings date.
Yeah,
The day trader doesn't care.
and the fundamentals are going to play out over an extended period. If I was taking a trade, I mean, I would always prefer to have the fundamentals backing my trade, meaning if I believe that this is a good
Yeah.
business, I'd more be inclined to play it to the upside. If I believe it's a bad business, I would be more inclined to trade it to the downside, because I think the fundamentals are going to play out long term, but they don't play out in any sort of short term way. So anybody that says, I'm going to be in this for a couple of weeks, a month or two, you're trading, you're not investing. And that's very different. And this concept is much more. So I'm glad you brought this up, because we do need to distinguish between the two. We're talking trading here. We're talking what would be the best opportunity for the next couple of weeks and so on. From an investing standpoint, it's all the fundamentals with a little bit of technicals, meaning we can still identify some key levels and where this might go and where we would best pick it up and so on. We'll use the technicals a little bit to identify some key metrics or what we're seeing, or maybe there's a big exhaustion low that we feel like is kind of set, a temporary low. We can still use this to aid and assist, but we're putting by far the majority of our emphasis on this as an investor. So it's kind of, as far as 80-20, let's call it. If you're a trader, 80% of your emphasis is on technicals. If you're an investor, 80% of your emphasis is on fundamentals. It would probably fit something like that. So if I look at a chart like this, I see that there's massive overhead resistance. The problem is one of momentum, but I'm not going to try to buy this on momentum. Like if I believe that this is a great value and I want a position and so on, I'm going to buy it more when I think it's bottoming, creating an exhaustion low, hitting a support and bouncing. I'm going to try to buy it at the bottom, not buy it at the top and so forth, right? So it would kind of still fit the same mold of, I'm still going to be more inclined to buy it low, buy a pullback versus buy a breakout, because I know breakouts just won't have momentum anyway. So I might as well get the best price possible as an investor, right? Which is down in the dips and such. So I try to buy the lower end of the range, not buy a breakout at the top end of the range and such. Now, when you think about it though, if we were to take some of the best fundamental companies out there, like an Apple or something, the tricky part is that they may not give you massive, declines and such. It might be a situation where some of these dips, depending on the market environment and such, they'll still give you opportunity, but it'll be opportunity that maybe doesn't last that long. Like if I was looking at Apple, it's been cut in half a few times. If we were to go back just in the past 10 years, there's probably been a couple of times where it's been roughly cut in half. So here we went from, let's price label this, and we'll see if we can see it a little bit better. So I'll price label it. So here we went from 21, this is on a split adjusted basis, to 11. So it got cut in half there. Here it went from 30, so not quite, lost a third of its value there. Here it went from 56 to 34, not quite half of its value. Here from 80, this was COVID, 80 to 52, not quite half of its value. But you can see 181 to 123, not quite half of its value. But to Andy's point, as an investor, I'm really much more inclined to try to get the best value possible. And value comes from two things. It's not just low price. That's low price by itself is a trap, because if it doesn't have good fundamentals, earnings, revenue, it might be a trap door right there. Value is a good lower price in comparison to the amount that it earns and it brings in revenues and what it's expected to do in the future, and its dividends and how those dividends are going to increase and so on. So it's a value proposition if it's giving us one of these low prices, but the earnings are going to stay strong or going to improve in the future, and the dividends are going to keep increasing, and the share buybacks are going to keep increasing. As long as you have this that's strong and you get this, now we've created value. What happens sometimes is you get lower prices and the business is deteriorating as well, right? The business is not going to be as good as what it was in the past, and that's what they call a value trap, where you think it's good just because price is coming down, but you don't get this. And if this doesn't stay strong, improve, et cetera, then it becomes a little bit of a trap situation.
Beautiful. Good delineation between we always want to have our trader hat on and our investor hat on when we're doing one or the other, and look at it through that lens and that context. Very important to do. Benjamin Graham, he would decry trading a lot of the time because he loved investing so much. But even in the book, The Intelligent Investor, he says, look, if you're good at it, great. Just don't commingle the ideas. Just understand when you're doing one, when you're doing the other, and don't commingle those types of ideas. Don't let an investment turn into a trade, and vice versa. Trade your trade, invest your investments. So there you go.
Yep, love it. We had a request from Mark, and I think this was back on the S&P chart. He's probably in coaching, but we talked about this is.
Someone asked us, sometimes people ask stuff, and I say, oh, we'll do that, and I forget. So if you asked us to do something we said we would and we forgot, forgive us and re-ask us, and we'll see if we can accommodate a million people. But
here is what he was referring to, which is just a technical idea that if you follow Elliott waves, and Noah and I are talking about, and Andy are talking about putting together an ultimate technicals course, and really breaking this down. But this would just be a quick kind of overview of this concept. This is in Elliott wave. Basically, if you're in a bear market, you make 5 big waves to the downside. If you're in a bull market, you continually make 5 big waves to the upside. And then there's correction. So we're in a bear market. The first wave, the second wave, the third wave, which is usually the largest, the fourth wave, and then the 5th wave down. And then you go through what's called an ABC style correction. And usually the ABC comes back to about where the 4th wave was. And that's what the market has basically done. It went through this big downturn. It's now gone through a big correction. And perhaps, maybe we're going through a new bear market cycle. That would be, in my opinion, probably most likely, is that the bear market persists for a while And that's good news. That's good news for the investor for sure. And it can be great news for traders as well, because in essence, if it's doing that, what does that mean? Lower prices. If you think about Warren Buffett, why does he say he loves when markets are in a bear market? Because he has things to do. He has investment opportunities. The shooting fish in a barrel analogy that he talks about is there because now he's getting people just throwing their stocks away at any price, at any value, and he can step in and pick those up at a great opportunity. And so bear markets present the most opportunity for the investor. And they also probably present the most opportunity for traders, because if you're trading the market in front of you, markets have a tendency to go quickly and violently lower when you're in bear markets. And when that happens and you're positioned correctly, you can make more money in shorter periods of time. So it's not a bad thing for us on either side, on the trading or the investing side, if we do go even further in this bear market, which is kind of what I would think is most likely. So hope that's helpful.
Very helpful. Should we kind of give a state of the union on where we are in progression of what we've done so far in the Quick Start Lab?
So let's come over here. Let me look here at what we had. So we want to go monitor and just look at, we've got a few of these that we have done here in this. So we have done a lot of stuff with Oxy, and maybe we'll start there because we started with a bull put. You can see that this trade is working, right? It's working as planned. We've got profit. We even took off a couple of contracts. We still have 3 working. SPY, we bought a protective put position in SPY. That was when Noah actually was here. Andy, we talked about that and bought a put in SPY. And then last time we talked about the poor man covered call in GDX. Now that one hasn't moved much, but you know, it's progressing the right way. Stock's up a little, plus we got the time decay. So those 3 trades have all been from Quick Start Labs, right? So if we take them one by one, Oxy, let's go in and analyze that position first. So if we look at Oxy on this, let me bring this over here. Why is this not cooperating? Where's my Oxy trade?
Maybe go to your Analyze tab and let's look at that.
Yeah, I was in it, but it's not populating. What am I not doing here?
I know what it is. Let me remember. If you look at your single symbol, all your series, is that going to do it down there where you've got that checked? Let's see this. See where it says all one series? Nope, that's right. I don't know why that's not populating. I have no idea.
That's what I was trying to figure out. Well, let's see if this one will cooperate. So let's go into SPY, see what that does. And if I have to shut this down. So let's go here. This one works. So, and we'll come back to Oxy in a minute, but here is our SPY 400 strike put. We paid $10 for it. You can see that we're now in a position where, again, if we went back to the monitor, we're up a couple $100. So its mark price is now $12.16, and we paid about $10 and whatever for it. So $10.03, I guess it is. So we paid about $1,000 for that insurance contract, and it has gone up to $1,200 in value. So that's pretty basic. We just bought one put. You can see we're long one put with a negative 56 delta. That means that every dollar the SPY goes down per share, this contract is going up about $56 in value. There is time decay in this one. It's an April position, and you know, it's progressing. As long as the market's going down, this thing is working and going up in value. And that was kind of the point, is, well, the market's probably going to go a bit lower. You could buy some protection So as some of your other investments go down, this will go up and it will lessen the blow. It will offset some of that downside risk. We didn't fully delta hedge. We didn't beta weight and buy a ton of those contracts or anything. We beta weighted, you know, if you beta weight this to SPY, we would need negative 238 more delta. So we'd have had to have bought, you know, 5 more of those or something to get negative 250 total delta or to offset our total portfolio. But the point being, we just wanted to show it in action. We just bought one and we hedged off a little bit of our risk, right? We took our net exposure to the market down by about 20% or so, something to that effect. And so, you know, it's kind of doing its job that way. GDX is an interesting one. This is the poor man covered call, right? We bought the long-term leaps. We sold the shorter term out of the money call for income. And look at this. This is kind of interesting. This doesn't always happen. A lot of times in spreads, what will happen is you'll be making money in one and you'll be losing in the other, right? This happens to be a case where they're both kind of working in our favor. Like if we go back to Oxy, you'll see that we're losing in a couple of these contracts. We're just making money overall because the options we bought for insurance, of course, are losing, but we're making more. The put we sold is up 226 bucks. The put we bought is losing 106. The call we sold has made 361. The call we bought is losing 139. That's the goal. We want this protective option that we bought to go to zero and this protective option that we bought to go to zero. But we also want these to go to zero as well and we make our money, right? So it's just a little bit that way. It wouldn't have surprised me if on GDX, this one was profitable and this one was at a little bit of a loss. But it just so happens that both have a little bit of profit in them. If we look at GDX here, and we look at the risk graph, we can kind of see what's transpiring. Remember, this is at expiration risk graph, and then this purple line is the progression risk graph. I need to bring this back. And that might have been our problem with Oxy. I don't know if I had the wrong date on there. We'll click back to it. That might have been. Maybe I had the date there off. So
maybe.
What do we have here? I think I can delete that one. Yeah, here's our actual position. So if you just kind of look at it and the risk graph and whatnot, here's where the stock is trading. Here's our ideal price point. And we could even set these slices to break evens. And you can see we would have to go up an enormous amount to overshoot and hurt us. And if we go down, we could lose money if it goes down too much, but the stock's right here right now. So it's kind of progressing the right way. And that's why we're up a little bit in this trade. And it's a two-part trade. Yes, we anticipate some upside, but we also anticipate that short-term option expiring.
And these are where risk graphs aren't as, I don't want to say useful. They're so useful. They're just tougher because when you have different dates, it really kind of skews them quite a bit. You know, one of the cool ways that I'll sometimes look at this with newer people is I'll look at each trade individually and I'll say, all right, let's uncheck our short one and uncheck our long one and see how we're doing on each one.
Yeah.
So if we uncheck that one, we say, okay, well, this is looking like we're doing okay. And that's, you know, there's no skew-wampousness to that. If it goes up, we see clearly where we're making money. If it goes down, we see clearly where we would lose it, right?
Yeah, and that's just the leap. We just isolated that one long-term call option. So perfect.
If we uncheck that one and we look at the other one one time, we say, oh, okay, well, here's our $41 that we've got, and it looks like we're, you know, headed towards making that money with time decay. If we got out of that one right now, we'd be down just a hair. I believe. Well, we might be just a.
Yeah, I think it was a tiny profit.
Tiny. Yep. Is it a tiny profit? I can't see. My eyes aren't good. Looks like the red hash is just on the, like a buck.
Yeah.
So by isolating those, it helps us see them better.
And you could see, like, that's easier to see back here where you just open it up and you can see according to this, we got a tiny profit because it's calling the mark price about 38 cents and we collected 41 cents, right? So it's saying, hey, we're up a tiny, tiny, tiny little bit on that, on just the short leg. So if we just isolate that one, we're just up a teensy tiny little amount, you know, dollar or two. But basically in the total trade, it's progressing, and it's going to be, this is not something where you're anticipating that's going to have a really big payoff, because you can see that over the next month, this is just from now until March 17th is that first expiration, and then we'll make an adjustment and then another adjustment and so on. We keep selling these short-term options, but in the short term, realistically, if we were kind of thinking about, well, where can this stock be between now and then? And, you know, where's it likely to be located between this period and all the way back here? We got to come in a long ways. I went a little too far. If we say, where's it likely to be between now and March 17th? It's going to be between these prices, right? And this is really what we're trading right now, is we've got a position on that, yes, we're going to hold this. This is going to be a core position until 2025 or until we decide to get out. We might get out of it early, but it's something that lasts a long, long time. But we really kind of need to think about the trade as, okay, now to March 17th. And then once March 17th hopefully expires and we made our 41 cents, then we analyze and we sell the next option and we move on from there. From now to March 17th, you can see there's just not a lot of expected movement. Somewhere between 26 to 30 is basically your expected price range. And most of that is profitable for us. From about here to here in the shaded area is a profit. And then obviously this little section, we could easily be here. That's very probable, the market tells us, but that's an unprofitable little area. Here's a profitable area. So we've got kind of a good trade from that standpoint. Or you could just pull this over and you can kind of see that, well, from this side, we're probably profitable, and that's about a 70% chance. And from this side, we're unprofitable. Well, that's about a 30% chance. So we're kind of just set up pretty darn well to make some money here. But it won't be, you know, it's not likely to be some gigantic gain. There's not a huge amount of profitability in this in the next couple of weeks, but there's not a huge amount of downside either. That's just kind of where it's at. Let's go back to Oxy. I think we found
maybe it's
problem.
the date. Yep.
Go. So I didn't realize I had that date. I'm not even sure why I had that date pushed forward.
Marched forward a little bit. Yep.
So here's our Oxy trade, which has been a fun one.
Doggone thing just will not fail.
Look at where it's at. Look at where that stock is at.
We're darn near right in the middle. I'm going to just say a word about delta hedging. We're not going to be able to do it, and it really isn't as cool. But we're going to delta hedge it where it is, and we wouldn't do that on this trade. You can see that we're really not in you can see how small the Bermuda Triangle now is. I mean, in this one, if you were to take and trace the Bermuda Triangle on the top side, it's like ultra tiny, and the Bermuda Triangle on the bottom side, it's like semi-tiny. It's like, it's the part where I like to draw mine. Yep, like actually the other way. I like to draw it where I'm still would make money in that. Like I like to take mine. This is where I like to do it. Let's go and put it right. Nope, not the triangle I like is at the strike over to, yep, to where just between the two red hash marks. That's it, where you're losing money, just between those two, laterally and then down, and there you go. There's your Bermuda Triangle. And the reason I call that the Bermuda Triangle is why is that painful? I'll tell you why that's painful. The reason, if this stock was at 54, your dilemma would be is if I get out of it now, I lose. but if I hold on to it and I get lucky and it stays, I win. There's your dilemma. And that is the dilemma that blows up people's accounts with these trades. So if you picture the stock at 54, we would have maybe a, maybe a $200 loss on it probably. If we put put your crosshairs, does that work? Yeah. So we have a $95 loss. Okay, so this is perfect. So if you look at the little box at 323, we're down 95, but at 318, we're up 119. And that is the dilemma. That's it. I see this here and I'm like, oh, if I get out today, I lose $100. I know I'm getting close to losing money. My break-even point is at 53.61. I'm only 40 cents above it, but man, if I can just hang on for another 2 weeks, I make $109. I keep my $119. But if I get out today, I lose $94. I think I'm just going to hang out and hope for the best. Psychologically, I think that's a tough place to be. Is you're getting close to losing control of this thing. You're getting close to being in trouble. The likelihood, but going down there right now is only 7%, getting below that. But if we were at 54, the likelihood would be like 45% that you're going to lose, right? Because of where the stock would be. So I think that's one of the big psychological traps of this type of trade. And then the other psychological trap of this trade is that individually, this strategy works probability-wise, but collectively over time, it's a losing strategy because obviously our profit is less than our risk by about a third. And as you work out of time, even though you might only have a 10% chance of not having to work out, one bad trade eats up all your profits. So those are the double-edged swords of the Iron Condor and why people blow up their account. I will just tell you, when you get in the Bermuda Triangle like that, you got to do something. Well, we're not there, but let's pretend we were, and let's put a price slice on today's price. Let's just throw a price slice on that. So if we hit the plus sign, yeah, okay, you can just move it. And let's pop our drop down, our drop down menu where price slices are. Let's see, over to the right, go all the way to the right. It's kind of just below. I know I'm a thinkorswim guy, and he's
so what are you?
Go to your left, all the way. You're right up
to the left.
Oh
yeah. You were saying to the right, and so I was.
I'm an idiot. Well, my other right. So you can see three price slices here, and the one where we're at today is 60.45, right? And if you look at that 60.45, there's a delta of 21.48. So is that where we're at? $60.51.
I tried to land it right on there, but it's pretty close.
Perfect. Yeah, it's pretty close. So we'll call it $21.49. So what that delta means is that when the stock is at this price, if it goes up $1, we're going to make $21.49. And if it goes down $1, we're going to lose $21.41. And if you look at the purple line, there's an ever so slight slope to it, right where our price is. The gamma is how that slope changes in time. Now, if you look at the delta at 53, you can see it's a much steeper situation to where if it were to move $1 or up or down from there, we'd be at $100 different loss because you can see the delta on the price slice. If we go up to the 70, we see a curve going the other way, and it's negative because it's sloping the other way. And that says that, if it were to go up, we'd lose $85 on $1 going up. We'd gain $85 on a stock going down. The reason that one's negative is because the slope of that purple line is different. So one of the things we could do to put acid on this, and we go into tremendous detail in the ultimate options here, but we can give you kind of an introduction, like the quick start of this, if you want to start quickly, is what you want to do is find an antagonist to neutralize that slope. So in other words, we need to find a trade that has a negative delta of 21.12, a negative delta. So if we were to short 21 shares of this, it should change that line a little bit, right, Corey?
Yeah, what it would do, to your point, is see how this just, you can barely see it, but just see how
It's
it
so
kind of
flat,
slopes
but it's
down right there.
just a little down.
If we added 21 shares short, it would neutralize that delta right there to the point where it would just go flat, perfectly flat. Why? Well, because we'd lose 21 cents on the option trade, but we'd make 21 on the stock, right? And so it's just
And vice
perfectly
versa.
flat from a delta
And vice versa.
and vice versa.
So
Yep.
that would pour in asset. In fact, maybe we could add a simulated trade of 21 shares of Oxy and see what it does to our delta. If we just add a simulated trade to that. And then look at our risk graph. Let's see, will it simulate that trade? Okay, now, what we see now is that delta right where Corey had it circled is now 1/10, it's like 11 cents now instead of $21. And you can see that we have now neutralized this trade, neutralized it. Let's, just for fun, let's short another 97 shares just for fun.
So you want to go from 21 to
Plus, I just saw
plus
the
97. So let's go 97 plus 21. 18.
108, some way. I don't know. Let's look and we'll see what the delta is and change
It'll
it if
be
we.
118.
Okay, so let's look and analyze that trade. Okay, now what you can see is the price line. Oh, we got 20 shares too many, it looks like.
Oh, yep.
We got 20 shares too many. So let's just go
back to 98.
Yeah, something like that. Boom. Whap. Okay. Oh, no, we went the wrong way.
Is it compounding these? It might be compounding them.
Let's take it up, and we're probably just adding a whole bunch of them here.
That's what I was thinking. It is.
All right.
So I need to nuke these.
Get rid of get rid of that one, and there you go. Okay, now if you look at the delta down by 53, you can see that if this stock was down to 53 instead of the delta 0, and you can see how that would freeze. You couldn't make or lose any more money on that part of the Bermuda Triangle. You can see now, if you see the Bermuda Triangle, you'd see, if it goes down or up, it doesn't matter. Now, it really sucks because this hasn't gone down. And this is why it's so hard to teach this without it going down. One of the reasons we are aggressive in this is we were hoping that it might wind up here. But basically what you do is, let's pull the delta hedge off, Corey. Can everyone see? Let me ask a yes or no question. If you say yes, I'll feel better about it. Can you see that what we did at the 53 price slice leveled off the purple line? Does everybody just understand that? How it happened, let's not worry about, but you can see that by shorting 118 shares, we leveled off the purple line, right? Okay, now let's pull that hedge off. So if we were to be stuck at 53.61 and we're down, 100 and whatever, that would freeze where we're at. In other words, if it were to go down further, we wouldn't see how we can lose $1,000 if it goes back down at that rate. Well, if we freeze it and neutralize it, we're not going to make any money on this trade, and we're not going to lose any more money in this trade. We're just going to freeze our loss as is. And what that does is it prevents us from taking a max loss. And the nice thing about that short is we could put an order to buy it back if the stock starts to rise again and get back in our neutral position, where we might not be able to make money in this trade anymore, but we're not going to lose huge money. Now, someone might say, well, why not just, get out of the trade at the loss and say, hey, well, because there's a probability of touching and a probability of expiring. If I delta hedge, I buy myself some time for it to come back into the good graces, and I might make a little bit more money with it. But if it goes down, I'm not going to be hurt any worse than I'm already hurt. If I just get out, I'm accepting that punch in the face. I can't come back in the next round of boxing and win the match. I'm just, throwing in the towel. But if I delta hedge, that's more like taking a timeout and saying, hey, let's just give ourselves some time here. Let's buy ourselves some time. And if it does bounce back up, then I can pull the hedge off, and there still might be some profit to be had, and it just helps my numbers overall. The most important thing I can tell you is that we can't take that $1,000 max loss. We can't do it because it eats up all the profits of this trade and all the others that we've done. We cannot take that max loss. So one of the things we could do is delta hedge. Another thing we could do, Corey, is we've got 3 contracts. Maybe we take one of them off. And we talked about that last time, I think. Yep. 2 times. I talked about that. So that's a huge deal. So, Sean Stone says this is like putting an iron condor on that's too close on the losing side. That's kind of what we tried to do, is shrink this so we could have a loss where it wasn't wide, it was narrow. But the doggone stock is just, well, it's your fault, Corey. You predicted a neutral market. And we have a neutral market, and so here's our neutral market.
It was the right trade for the right environment, et cetera, but obviously
the other trade that would have been
awesome to teach. Yeah,
I'll tell you, the other trade that would have been awesome is watch this. Watch what this would have done. Pull the longs off. Pull the longs off. Okay, now there's a short strangle. Now, if we'd have made this trade, we'd have made money on just the volatility crush. So if we look at the graph and decide how much volatility was lost when the earnings came out, we could actually retroactively see how much we would have made on that. Because now without our longs, we're making even more. And we weren't going to try to be in this for very long. We're going to try and beat over the volatility crush. So that cogwheel over there on the right at the bottom, kind of by BP effect, that opens up our volatility adjuster. And maybe we say it lost, I don't know, what do you think the volatility drop was in that thing?
It was pretty substantial. We looked at that graph last time and it was just straight down. I mean, probably
let's say it was a 10%. So if we add 10% back into that volatility, it should drop that line. See, that's where it was before. And if we add that 10% of volatility back in, now watch overnight. Let's say that's what our graph looked like, and we're up, 476 on it or whatever. Okay, fine. You pull that volatility off and make it zero where it is today, volatility crush. Now we're up 200. You make $200 like overnight. Overnight. It's not a time decay trade. It's a volatility trade. So the reason that we talked earlier, at the beginning of this Quick Start Lab about the 3 monsters, the Delta monster, the Theta monster, and the Vega monster, is as you become more experienced, you can find all kinds of different ways to cash flow these changes. And the reason the volatility crush is such a cool one is Delta, you can't predict worth a darn. We're trying to get some probabilities of where it might be, but we're just throwing out probabilities. It's really hard to predict direction. Time's totally predictable.
And the chart's helpful for that. Like, if you look at this chart, how on earth could anyone predict? You might get the general range right, but there's just no way that we could have said, well, it's going to be up for 5 days, then it's going to come down for 6 or 7, then it's going to go sideways for 6, then it's going to start back up. Just unpredictable.
But
right?
We can't predict that volatility crush that we saw in that graph.
For sure.
Because we say, hey, we're going to hit earnings and there's going to be less unknowns. There's going to be some knowns to replace some unknowns. That should drop volatility. And we can make
low predictability, at least medium, right? It's very, very much more predictable.
Yes.
Right? And time would be completely predictable.
Yep.
Theta is perfect predictability.
And this is a theta trade that we're in. we're not trying to guess the direction so much as we're guessing a range. And that's easier to guess a range than a direction with Delta. And we're going to let time tick away. And luckily, we also got the benefit of the volatility crush too, because we sold this when the volatility was high and we had a net credit, or we were net short. We have more short exposure than long exposure, which a volatility crush helps. So this has been a really nice trade. Why do you get lucky every time? Maybe it's not luck, Corey. Maybe
We
you're
just
actually
need to, you know what it is? We just need to do a quick start lab all year.
Yeah,
And we could just be, it'd be like a money printing press, right?
go. Yeah, there you go.
No,
Gee,
so
man.
it's kind of interesting when you look at this, that if you look at the short strangle like he was talking about, so notice we unchecked buying the insurance, and you can see what that did is this just goes that way and this goes that way. Now it's unending potential losses. So it opens up the floodgates because now you're naked on both options, right? You're naked the puts with no protection, you're naked the calls with no protection. So the list, the potential risk is undefined, unlimited, infinite potential risk and so forth.
Yeah.
And same thing here. But what that does is we say, okay, well, infinite risk, I get it, but it's probably not going to be out here. And by the way, I could hedge and do some things. But what it did was it bumped up your profitability. Notice that the max profit now comes in at 690 on the 3 contracts, whereas if we put the Iron Condor back on, it's only 420. So what it does is it eliminates the cost of these two protective positions. Basically, $40 times 3 and $50 times 3. So you're saving yourself, 200, 300 bucks in cost, but those give you something. They give you a flat line right here. They limit your worst case scenario. Why would it be better to take these off maybe as a volatility trade? Well, the reason it's better is because if it works as expected and vol drops, now
Only your short ones gain and your long ones
pure
lose.
profit, right?
Yeah.
Exactly. Because
Yeah.
normally your insurance that you bought would also lose and to a volatility drop. If we don't buy those, well, then it's pure profit. The two shorts profit from that volatility decline, and it's doubly good because you got both of them short and so on and so forth. But there is added risk there. No question, added risk on both sides.
The other thing you would do is you wouldn't sell a front month. Generally, you want to sell less time, but if you go out,
Vegas higher. Yep.
The Vega, exactly. The Vega is going to be higher if you go out months. Now, I want to address Sean Stone's question while we're doing this. And Sean says, well, couldn't we just build one that's off center now? The reason we can't do that is that every time you build a new trade, like for example, if I bought a trade right now or sold a trade right now, I could immediately buy it back for pretty much the same price. In other words, you can't build a trade that you're negative in out of the gate. You're always, so even though it might be, the strikes might be different, you're still going to be at neutral.
Break even. Yeah, you're always starting at break even.
We were trying to do that at the beginning to hope that it could, the narrowness of it would get us there. But because this one's probably 30-40% narrower than we would have done otherwise. So it's kind of tough, but keep coming to Mentor Club. We'll eventually have one that goes south. We'll eventually have one. Go back to this discussion of Vega. If we go out to a front month, the Vega is not as powerful for us.
So look at the monies. Look at the at the money Vegas, and right here it's about 5 cents for a short dated.
Yeah, and what that means is that with a 1% drop or increase in volatility, the option premium would move a nickel.
Yep. So you'd make 5 cents being short that one and 5 cents being short that one to a total of 10 cents.
If you had a
profit,
1% drop.
So $10 of profit for a 1% drop in volatility. If it dropped 2%, well, now you'd be up 20 bucks, and it dropped 3%, now 30. But it's 10 cents on the on the 1% move. Now
That's
watch
the money.
this.
That's on a
Yep.
straddle. If
That's
you
on
do
a straddle,
string,
but it's kind of easier to
work.
teach
Yeah,
maybe
yeah.
with that one. But yeah, so it's a
Because you
little
notice
different
your
because it's a
Vegas-
straddle.
Notice as you get farther away from the money, the Vegas drop as well, right? 9, 8, 6, 5, 4.
But this
And now
kind of
we go up.
shows the difference.
Yeah, 9 twice as good, right? 40%
Yeah, so now
better.
we're making almost 20 cents on a 1% drop instead of 10 cents
Let's
on a
go out
1%
a little
drop.
further. Let's go out a little further.
Let me clear off the drawings here. So here's May, same concept. What if we sold the at the monies and now it's even a little higher? Now we're up to 22 cents or so. You know, so it went from, it was basically 10 cents total to 18 cents total to 22 cents total. And if it's kind of the two negatives make a positive, right? We're shorting this option and we're shorting this option. And so if they go down in value, which is what's going to happen on a volatility crush, we're going to make money from it. I hope that makes sense. So we're going to make 11 cents as that option drops on volatility decay. And we're going to make 11 cents as this option drops from its 390 to goes to 380 or so because volatility dropped 1%. And so that's a profit maker. You're short the options, so you make money from volatility going down. You would lose money if volatility went up, by the way. If volatility went up 1%, well, these would have more risk in that situation because you'd lose 11 cents and lose 11 cents accordingly. So you're basically, when you sell an option, you can just kind of say, well, I'm short the Vega, right? I'm profiting from volatility dropping. If I buy an option, then I'm long the Vega. I make money if it goes up. I lose money if it goes down. So that when you sell options like we're talking about here, you would be short that Vega.
Yep. So Lynette says, so an iron condor is a theta trade and a short strangle would be a Vega trade. They're actually both advantageous. They're both the same, Lynette. Actually, ours benefited from Vega and theta. The short strangle benefits from theta and Vega. The difference is with a short strangle, you don't have protection. So if you had a catastrophic move either way in delta, you'd get hurt much, much more. And so it's just a more aggressive trade. The reason I will often do the short strangle for Vega is because I can go clear out to May and I can make this thing so much wider. I can make it way wider. And so that delta might not hurt me as much because I can go and get the same type of Vega with a wider strangle than I could with a condor.
Yeah, and let me show you the math on that. So instead of doing the condor where we would sell this option and buy this option, and see how you sell this for $1 and you buy this for 50 cents, you get 50 cents total roughly or whatever, right? Yeah. So instead of doing that and being, now your risk is that it's below 50. Yeah. He says, well, forget that. Instead of collecting 50 cents between the two, what if I just collect 50 cents almost for this one? And now I've got $5 of extra room. You see that? Before we were losing if it was below 50. Now he's got $5 of extra padding before he's at a bad spot for almost the same amount of credit. Now it's a naked option, but
and I'm getting 4 Vega, right? Yeah. I'm getting 4 on my Vega. Whereas there's no way I'd get 4 Vega on that in the front month.
Well, not even in the spread, right? Because yeah, to your point, if you do both of these, you're only at 2 Vega total. And so if you just eliminate that and move this down, so instead of shorting this, buying that as a spread, as a $5 spread, if you just short this one by itself, you get $5 of extra room. You get almost the same amount of credit. You get a higher Vega. You get probably the same theta. And you know that you get all those positives, But there's one big negative, one huge negative, and that is that it is naked.
It is naked. Yep. Naked.
Now,
So
naked sounds fun, right? Usually, but
well, it's not fun if you look like me, dude. I get out of the shower, I look in the mirror, and it's not fun at all. Okay? I don't even take my shirt off at the public pool because then Facebook lights up with Bigfoot sightings. Okay. Like I went to the public pool, I pulled my shirt off. Next thing, Facebook sightings, Sasquatch. They're real. I saw one. It was about 6'8". You know, didn't smell bad, but it sure looked ugly. I'm telling you what. I know that this is a lot.
Fun. Naked's fun unless it's the wrong situation, right?
Yeah.
It becomes a problem if you're naked in a situation that you don't want to be in. Okay, so naked fun in good situation, in the right setting, naked can be fun. In the wrong setting,
don't tell your spouse you were doing anything late at night naked using the internet. Okay, what were you doing on the internet so late last night? I was doing naked, whatever. Yeah. What?
I'm studying about naked whatever, and it's going to be a weird discussion.
Naked
but
call, girl, huh? No, naked call. No, just the call, not that. Oh my gosh, man, this is so bad. Hopefully there's no one under the age of 13 watching today. Sean's like, naked isn't a good look for a man. Oh, I'll tell you. Well, it just depends. Like you say, the situation. It just depends. I will say this. If this is kind of breakneck stuff, don't worry about it. Keep going to Mentor Club. And the advantage of this is it gives you more tools in your tool belt. And a lot of people get confused where I'll say, I don't really care what the market does, up, down, sideways, whatever. We have so many different ways to draw cash flow from the market when we have a tool belt that's got a lot of really good tools in it. So, build your tool belt. My son David is now my son Zach. I'd say Ultimate Options probably a year-long course. He did it in 9 months. He was pretty aggressive with it. He did it in 9 months. My son David's starting it now. He just finished up his 4 pillars, and he's starting his Ultimate Options. And then your playbook is where you adjust. Like how would you adjust out of this stuff if you had it start to go bad on you? Okay, how do you adjust beyond just delta hedging? How do you turn one thing into another? How do you turn credits into debits, and how do you turn ratios into verticals, and all that type of stuff? So there's a whole world out there. And what makes a person decide how far they want to go? I think there's 2 factors that help you decide. I think the first factor is do you like it? Because if like talked about this before last session, I think, is if you don't like learning this type of stuff, and it's just like if a person just wants to make money, then this is kind of like a job, right? It's kind of like, yeah, I want to be a doctor, so I'm going to take all this freaking organic chemistry so I can get there, right? I just want to be a doctor, and the organic chemistry is painful. Well, you'd be better off if you loved chemistry, right? You loved it. And then the second factor I think that's really important is as you design your cash flow blueprint, right? And you say, I want to design a blueprint for me. And I guess we could show that. Should we show that calculator? That might be a good way to end today, is to show that calculator. If you go to cashflowacademy.com/power6, I think that's what it is. I don't know. Let me show you this. This is not, no one's supposed to see this. We showed it in Mentor Club once, and Mike will get mad at me. I'm not even supposed to show this. I think I'm not. I don't know. Maybe I'm okay. I guess I'm all right in doing it. Let me find the thingy here. Hang on, people. Just give me a second. That would be here. And it's sent items. I think I sent this. And here it is. Okay, yep. It's the go here, Corey. Cashflowacademy.com Power of 6, and it's the number 6, not SIX. Can you get to a web page on that? Try
Oops,
it.
I was muted up.
Cash
Cashflow
Academy.
Academy.
It's got to be the Cashflow Academy, I think. Yeah, the
Cashflowacademy.com / what did you say?
Power of 6. Just like that. There you go. Look at this. Now, no one knows about this. Now, go down a little bit, scroll down a little bit, right? And there's one. Which do you prefer? Are you a Excel guy today,
yep.
or okay, here you go. And we're going to tweak this to where it's even cool for inflation. How many have seen this already? I'm just curious. How many have seen this already? I'm just type in, I've seen it, I haven't seen it. What's the, nope, first time, nope, seen it, nope, most people haven't seen it. Okay, so I'm writing this book called Power 6, and it really talks about income, expenses, cash flow, assets, liabilities, net worth. Those are the 6 numbers that change your life. Okay, those 6 numbers will change your life. Okay, and so right here you have your retirement needs, food, shelter, clothing. You put in whatever you want there, and what that gives you is a total expense number. So in this case, if you add up all the food, clothing, shelter, and we're going to add in some stuff to even adjust this for inflation when I have time, but this gives you a ballpark. You say, all right, this is what I think I'll want. If you want to do inflation in your head, it's 2% a year on average is what, 2.6 is a good historical number, 2.6% inflation. And it does change it. Let me tell you, it does. But let's say I want travel at 30 grand a year. So I want to take one nice trip a year to Paris, and it's going to cost me 30 grand to go or whatever. You add all that stuff up, and then it'll give you a total expense of 146,000 is what that is. Now, if I don't go to Paris and I say I don't want to travel, I want to stay home, and I put a 0 there, then that's going to drop that number to, it doesn't let you continue, whatever.
Well, it might.
There you go.
Is it going to let you?
Yeah, every time. Okay, now I only have 116,000 every year that I need, or whatever. So you put in your pension, which probably people don't have one, so we might put a 0 in the pension, and you might get some Social Security if you believe in your government. And then you say,
in unicorns.
Yeah, and then you say, okay, how much do I want to have for my assets? Well, in this case, I've got a $14,000 surplus, so I could actually go down to 90,000 maybe of my income goal. So I say drop that to 90,000 because I'm not taking a trip to Paris. Okay, that'd be a nice little surplus, $4,000 extra, a little cushion. That's great. Now you put in what you got in your 401k. So maybe someone has 10 times what the normal guy has, and he's got 850,000. Maybe a guy has 100 times more. He's got 8 million. Whatever you have, you put in there, and this automatically calculate how much money you'll need in your asset column if you believe you can have a retirement at 4%. Now, this is important. Corey, would you just somewhere on there in the blank space to the right, just draw a financial statement? Okay, I'm going to show everybody something.
Oops, let me change the color.
Yeah, change color. And go out in the white area to the right if it'll still do it. It'll be nice and clean. Okay, so you got a financial statement, okay? And you have on your asset side, you need a growth number. So you start with maybe in your asset column at the bottom, you have, now and then future. So you have now N, and then it goes up to future. So now, just draw an N in the bottom, and then draw an arrow going straight up to the future. So that's going to be your growth number. So in other words, if you look at this calculator, you say, well, I got 850 now, but I'm going to need 1.8 million, right? That's what I'm going to need to do this. That is if and only if your income, now let's go to the income column, you're going to put in 5%, meaning that I believe in retirement, I'm good enough in what I want to do to get 5% of my money. Now, maybe you're like me and you say, shoot, I'm never going to stop, doing covered calls and stop doing stuff. Maybe I think I can get 10% a year on my money. Or maybe I'm like doing iron condors, I think I get 20% a year on my money, whatever it is. But you've got to have 2 growth rates. So you can see that if you want to retire, and that's the really important one, what type of investing activity do you want to do when you retire? If you want to just put it all in bonds and never look at a stock again, you're going to have a much lower rate of return. Well, at 5%, you can see the required asset growth rate is going to be at 16.9. And as you play with these numbers, you can figure out, kind of build a blueprint for yourself of where you think you might have to be. If you say, no, I think I can get 10%. I'm good enough with my skills and I like writing calls and doing these options. I think I can get 10%. Great, go up in the income goal and put in 10%. Okay, well, what that means is now you're darn near there. You could almost retire right now. You only need $900,000 to do that. So your growth rate grows down. You say, no, I just want to put it in bonds at like 2 or 3% right now, because right now that's what a 20-year bond pays. So I put in 3%, and I don't want to invest anything other than that. Well, now I've got 20% during my investing years to grow, because now I need $3 million to get there. So what this calculator does is it helps you get a ballpark of what you want your retirement life to be with, what it's going to cost. I think this is this cool, by the way? Do you guys like this? Is this really like too much of a tangent, or is this cool? Type in cool if you think it's cool, and that'll make me feel better about taking the digression for this, okay? So what happens is let's say that I'm in this thing and I say, look, I don't want to give up my retirement. You dream big, okay? Like this is actually what we're going to do in Houston. Like I've got a special little version of this calculator that's a little bit better than this one coming out. And in Texas, everyone's going to like do this. Like we're going to lay it down and get your plan. So you'll decide, the idea is just get your dream retirement back. Don't settle. And once you decide what that dream retirement looks like, it becomes finite. In other words, once you put a price tag on it, once you decide what kind of food you want to eat and what kind of shelter you want to have, and you can do this, you see the tab at the bottom, Corey, where it says Retirement Calculator National? Okay, check this out. There's the data on what it costs for an average person to live on expenses. There's the data on what the average Social Security guy gets, depending on his income or hers. There's your corporate pensions of what the average is there, and there's your average 401k balances in America. So you've got this data that can kind of help you gauge your lifestyle and what it costs. Okay, so let's go back not to the national calculator, let's go to the dream one. So once you say, look, no, I want to only eat gourmet food and I'm going to go to Ruth Chris every night, okay? Calculate what that's going to cost. Because the moment the dream retirement has a cost, now it's finite. Now it is a finite limit. It's a project you can work on now. You say, okay, this is what I'm going to need. And then you look at the assets in retirement and you say, all right, well, I've only got $100,000. So you put $100,000 in there, or zero, or what, $1, or whatever you want to start with. And then you say, this is what it's going to take. This is the rate of compounding I will need to get my dream retirement. And so once you get the idea of what type of rate you need, now you're going to say, okay, and you'll notice that the strategies, when it goes above a certain percentage, the strategies are revealed as atypical or advanced, meaning that, getting 3%, you can see that strategy is typical. Enter an income goal of like, 20% a year, Corey, and see what it does. It's going to go to atypical, but now this one's like minus is typical, right? So whether you're typical or non-typical, and you can say, look, I'm going to build a blueprint of stocks, options, real estate, business, whatever, and I'm going to have to do things that are typical or atypical or advanced. Most people don't know how to write a covered call, and very few people are advanced enough to do advanced options, because as your rate goes up, the aggressiveness of your investing goes up. And so the education goes up to manage the potential risk. So, small return, low education, low risk, right? High return, high risk, higher education. So that's kind of the determining factor on how far you want to go with your investing. Some people may even want to start a business as part of their plan. because those are the highest returns. So there's a lot we could do. Like we're going to do a whole, like this is like the foundation of what we're going to do in Houston. It's going to be so freaking awesome. So that's kind of the, yeah, that's kind of the deal there. To kind of how do you decide? So let's go back to your screen, Corey. As you look at that iron condor, okay, as you look at that iron condor, you know, our ROI was $1,000 risk or so to $420 in gain.
Yeah,
So
420 versus 1,080 at risk.
That's a hell of a return. The problem is that's a little bit deceptive. Well, it's not deceptive, but it doesn't tell the whole story. If you say 420 divided by 1,000, that's a 38% return. Okay, this is an 18-day trade, which means you could really do this how many times? You know, let's say
100 times or something.
Well, per year. I'm just saying.
Oh yeah.
Maybe 20 periods per year. Is that fair?
Probably 20.
Let's times 20 periods a year. Okay, that's 7,000% on your money. That's ridiculous. Okay, you're not going to get 7,000% on your money. Why? Why aren't you? Because the probabilities of this thing when we started, I mean, right now they're at 90%. Let's pull our, let's set our break evens to, let's set our price slices to break evens. Right now, our chances of making this money is 91%. I mean, we are really high. But if you remember when we started off, wasn't it like 60?
70? Yeah, 70-ish, 70, 30, something like that.
70-ish. So even now, you know, if 70% of the time you win, that means you make $400, you know, 7 times. But if 30% of the times you lose, well, you can lose 3,000, you know, 3 times. So where you might make, you know, it doesn't work is what I'm saying.
Yeah,
you know,
and the losses probably wouldn't be max loss.
They can't be. They can't be. But they can't be.
Yeah, exactly. If you take max losses, this is never going to work for you.
It's never going to work. Never.
But the probability, to your point, I mean, you think about it from the standpoint of you can't just take, well, I would make this percent and then say, well, I would do this 20 times a year, because you're not accounting for the fact that you are going to take some losses. You are going to put some of these on ice. You are going to have some that you take off early and you hedge and you do, you know, so it's not going to be take 20 trades, have 20 profits. It's going to be take 20 trades, have some profits, have some that you hedged into smaller losses, have a couple of that you took off early at losses. And so by the time you're done, you should have some profitability, but it's not going to be 20 for 20. Yeah, exactly.
I mean, this was an extreme example because it was a short amount of time, less than 30 days. Number two, it's a very narrow spread in the narrow condor rather. And so we were being more aggressive this trying to get in the Bermuda Triangle. This actually is what a trade would look like when I start one. I like a 90% there. We wouldn't have as much profit. The risk reward ratio wouldn't be this good. But we were trying to be aggressive to hopefully get a deal. So there you go. Someone's asking about the Power 6 book. It's not done yet. So you'll have to wait for the ebook stuff. We're really close on it. Okay. Good stuff. Any questions? Cool. You want to do like a couple Q&A? I hate doing this because we can't get everybody, but.
Well, we had a great question come in that was like the best compliment ever. Arthur says, is Fortune Builders this good? So I don't know if he's going to Houston and thinking about, but
are you, where's Arthur? Let me see the question.
Yeah, he asked, is Arthur, I mean, basically he was having such a good time in this. He wanted to know if Fortune Builders was just as good.
Okay, so let me tell you, everyone probably doesn't know about this. So, and I'll give the link out if you I don't know where the link is, so I can't find it and I can't give it out. Lynette, you're very kind. Than Merrill, for those of you who don't know Than Merrill, Lynette knows Than. how would you describe Than, Lynette? Lynette says she loves Than. Do you know where the link is to sign up for this stuff is at all? Or you just
I
show
should
everyone
know,
else
but I don't. Oh, whoops! I'm trying to pull it up there
Yeah.
on a link. But
So anyway,
I was
I don't know where it is, but anyway,
gonna
the
pull
two
it up
words
for us.
Lynette
Let me see if I
uses,
can find it.
yeah, the two words. I'd love to go. Someone says, but I just had a baby. Well, if you had a baby, man, you better. Oh, like not today. Okay, you got a baby? That's a heck of a dude. That's a heck of a quick start lab if we got that happening, motivating people. So here's the deal with Than Merrill. Than Merrill went to he was the valedictorian of his high school, and he was the captain of the football team. He was a quarterback. So he gets a scholarship to Stanford. And so he's going to go play quarterback at Stanford. He's playing quarterback at Stanford. He's like, you know what? I think I want a better academic experience than Stanford because I think I'm going to transfer to Yale. So he switches from quarterback to linebacker and he goes to Yale. And he's just a stud. And he gets drafted by the Tampa Bay Buccaneers. So he played for Tony Dungy and played with Warren Sapp about that era. And he blows his knee out. He gets traded. He plays there 3 years, gets traded to Chicago, blows out his knee, and he winds up in a real estate seminar back in New Haven, back in his Yale neighborhood, New Haven, Connecticut, and he does really, really well. Well, about this time, there was a reality show called A&E called Flip This House, and they couldn't find people that could flip houses very well. And it's not a real good show if you can't flip the house. So they said, who's the best at this? And someone said, we got to get this guy. So they go to Than. They say, hey, would you do a season to flip this house? Because you know how to do it. And the dude flips 100 houses a year. That's one every 3 days. Think about that. How good do you have to be to flip a house every 3 days to get 100 a year in? So he does a couple seasons to flip this house and has fun. And he says, you know, I'm a good systematizer, and I'm going to teach people a system of investing in real estate. And he doesn't do as much teaching now. He's got a fund that has $1.9 billion in real estate in it now. So his time managing that has, and I just watched this whole thing happen. I've known him since like the beginning of this stuff. Anyway, we do a sales and negotiation class that teaches people how to negotiate with contractors and real estate agents and buyers and sellers. And that's all real estate is sitting down and negotiating prices. If you want to fix it up, you negotiate with the contractor. If you want to sell a house, you negotiate with a buyer. If you want to buy a house cheap, you negotiate with the seller. If you want to have people loan you money so you don't have to use your own, you negotiate with them. So all that whole business is just doing deals with people. That's all it is. And so we do a thing like that. So that's what that is. So is it as good as Than's thing? Yeah, it's going to be insane 4 days. Some of you are going to both. You can get, I think, I haven't even checked. I think you can still get into both. I'm not sure. I'll give you a link. Email us, because I don't know where the link is, and I'd have to run through my emails to find it. But there's a link somewhere in a webinar we did that describes the event. So if you want to go check it out, but it's both of them are going to be freaking awesome.
I'm trying to find that link. I just cannot find it. So maybe somebody else has the link.
Maybe someone else has the link and they can type it in.
Somebody else is more prepared than Andy and I, but can share it with the group.
Let's talk about this. Solomon has a question. He says, oh, this is fun. Lynette says, I have a selfie with him. I need a selfie with you guys. Lynette, I want a selfie with you too. So
absolutely. Let's
get a selfie with all of us, right? Please demonstrate how to use an option to hedge. This is really cool, pretty simple. Let's go to that Oxy price slice again. This is a good question, Solomon. So if we go to the Oxy price slice, we can put a price slice onto days, or, you know, it really doesn't matter, but it's nice to do days. And we saw that the delta for it at 60.26 is 22. So you'd find a call option that has a delta of 22, or excuse me.
Well, depends on which way you're
Yeah, you'd buy
Yeah,
a put option in
but
this
you'd buy
case.
a put. Yep.
Yeah, so you'd find a put option that has a delta of
Negative 22.
negative 22, and that would do it. Because 20 shares of stock shorted would do it, right? Now the challenge here is well, it wouldn't be that big of a challenge because you just go out of the money. So let's look one up. Did we look one up?
Yep, I just saw. I'm going to send this to everyone. Look at Kai and Ron, both came through for us. TCFAinvestorsummit.com.
I don't know how to sign. Hang on. Let's do this. I'll do a screen capture of this. Hang on. Right here, like this. Boom. I'm going to send this to you.
Okay.
And then you can put it. Hang on, Corey.
I'll pull it up on my.
This is hilarious.
Here.
This is coming from Kai and Ron to Andy on his screen captured to Corey. Boy, aren't we efficient here?
Yeah, we're very efficient. And I did share with the group, so everyone sees it on there.
Oh, you know how to do that?
Yeah, well, I just shared the.
Oh, it's send to all. Is that how you do that?
Yep.
Oh, okay. Well, I didn't need to send you that then. Okay.
Well, that's okay. We want to show it this way too.
So anyway, if we go to those Oxy put options,
let's show their good work here. TCFA investorsummit.com. So there you go.
So here's back to Solomon's question. Solomon, let's go to the options chain.
Yep. And we would be looking for a put with a negative 22 delta, right? Because, well, 21 at this point.
21.
Negative 21. And you'd probably, I mean, you could use really short term, but sometimes it's better to use something that has less time decay.
Yeah,
right?
You can have less time decay, you can get the money back out of it. Maybe a low delta, or I mean, excuse me, a low theta decay is what we want. But
yeah, so even if we went to
May and just find a delta, there's one about 52.50, would you say? You like that one? All right,
that has about a negative 20 delta, so that would.
Can we
just and not a lot of theta against us?
Right there.
So if we
does that help, Solomon?
And if you watch, if we add one of these, whoops, if I take it down to just one contract and then analyze the trade, it's going to do the same thing in essence right off the bat that shorting the stock would do, where it just flattens that.
Yeah, we're flat.
And you can see how it skews. Notice how both of those hedges, see how this stuff goes all wacky? The reason for that is because, well, now it's changed the entire numbers if the stock were to make a big, huge move, because now you can imagine if I buy this put, now all of a sudden, if the stock were to just absolutely collapse to the downside, before we would have had a big loss, but now all of a sudden we have a put that just keeps making money. And so it has to account for that. Our profitability actually goes up as the stock goes down because we've added a new bearish position. So yes, it creates the flat right here around current prices, but it would actually accelerate the profitability on a downside move and make the losses less if we overshoot this way. If, however, it goes this way and you've added a new bearish position to this whole mix, well, what's going to happen? Your profitability is going to be lower going a long ways this way. And then, of course, not only did you potentially lose on the iron condor, but you'd lose all that you paid for this put. And so your loss would become deeper over here. More shallow losses on this side because you've added a new bearish trade to the mix. Deeper losses on the bullish direction because you added a bearish trade. So good if it goes this way, bad if it goes a long ways this way, good to flatten out this middle section, good to hedge in the immediate term. So
kind of a cool question we could that would be fun to talk about from looks like Cosman. Okay, so how many contracts are needed? Well, there's 100 shares per contract, and when you see that delta of 21, that's per one contract. What would really be weird is you could do two contracts with a option that had a delta that was lower, right, Corey? You
Yeah,
could.
two contracts at 11
Yeah.
would get you 22 total, right? 2 minus 11. So if we came over here and we said, instead of buying one of those, we said, well, maybe we buy two of these, and that would somewhat serve the same purpose, right? Because now we're getting.
And the money is kind of the money. I mean, I don't know that there's a big difference. You could pay 63 cents for that one, a little bit less than $1.40.
Double that for one of these, or it works out to pretty similar. And now if you look at it again, it's going to be pretty similar in terms of it still flattens this, still creates less risk this way, more risk this way, still adds a similar amount. It's $67 times 2 now, which ends up being 130, which was pretty close to that 140 for buying one of the higher puts. So
yeah, and that's a good comment, because how much would it cost to have in margin to short 20 shares, right? So you can kind of play that game too, because shorting 20 shares, I don't know what 20 times the amount it'd be 20 times 60, I guess.
Yeah, and that was this all feeds into to another question that came in, which was, well, what if you needed to hedge and you didn't have a lot of capital available? And so you say, well, 20 shares at $60 a share, that's $1,200. Here, we're talking about if you used options, you're creating a very similar hedge, but it's $67 times 2. Now you're only requiring $134 versus $1,200 to trade the stock. Now there's some advantages to one versus the other, in that this would have some time decay. Trading stock doesn't have theta, doesn't have time decay. So there's some pros and cons, little trade-offs there, but they're very, very similar. The options are going to tie up a lot less capital. So if you find yourself in a situation where I feel like I need to hedge some, but 20 shares would be a lot of capital or whatever, well, you could go to the options, and that would be a more lower cost way to create that hedge. So
very cool stuff. So we got our gold trade, we got our Oxy trade, we got our hedge, and here's what an interesting thing is. If you go to your monitor page and look at your whole portfolio, that's kind of what a beta weighting idea is find out what your total net delta is, your aggregate delta or net delta would be for your whole portfolio. And then if you feel there's a catastrophic type of thing, happening in the market, maybe there's another COVID breakout, and you think, okay, we could be in for another ride here. They just discovered this, COVID 2022 virus in, China or whatever. And maybe I'll hedge the whole thing. Maybe I'll just put a little antacid on the whole thing. Because if I sell everything, I'll have taxable events. But if I hedge everything, then I can just take the money from my hedge, and the insurance pays for it, right? So anyway, it's fun stuff, man.
Really fun. And what a great group. I mean, just a phenomenal group. So many great questions and comments. You guys have us laughing and just loving being here. So it's with great sadness that we have one session left, Tuesday, March 7th at 6 p.m. Mountain, 8 p.m. Eastern time. So we'll kind of tie a ribbon on everything on Tuesday, but so much fun being with all of you.
Way fun, Corey. You always do a great job for us, and I had some good laughs today. That was really fun. Fun to we never know where these are going to go. We have a general plan. I shouldn't say we don't. I mean, we knew we were going to talk about some stuff, but the questions, provide us with a steering wheel of where we might go with the conversation. So, really, really a lot of fun, and it's just enjoyable.
It really is.
Okay, we need a quick start end of semester party. Where are we having that at, Timothy? I'll tell you where we're having it. We're having it in Houston, Texas, man. Come on down. We're going to travel. I'm going to take spring break to Vegas. So that's where we're going. We're going to go see Penn and Teller. I
How
freaking
are
love
you? Nice.
Yeah, Penn's a stud. He, he's 6'7", I'm 6'8". Well, Zach is now 6'7". So we're gonna go see Penn and Penn. Well, I'll tell you, Teller. Do you know his name really is Teller? It's just Teller. Like on his passport, he changed his name to Teller. He doesn't have a last name referred to
One
just
name.
Teller. And Teller doesn't talk, on stage, but he'll totally talk to you, off stage. He's way cool. And he said one of the smartest things. He said one of the darkest psychological secrets in magic is to give the illusion that people have a choice.
Yeah.
And when he said that, I was like, the illusion of choice. Maybe that's why I hate politics. They're acting like I have a choice here in this, right? Oh yeah, the illusion of choice. One of the great things I learned from Teller, man. Those guys are awesome. I could watch their show 10,000 zillion times, and they are so gracious. They're a lot like Billy Joel. If Billy Joel is so thankful. He's blown away because he's not lost on, like, he has a song called "I Am the Entertainer," and it says, if I don't stay on the charts, I'll be put in the discount rack and all this.
Yeah.
And he's not lost on how hard it is to not be a one-hit wonder.
Stay relevant, yeah.
Stay relevant and have songs that last from 1978 till today that the kids know. And so he's the same way. He's like, hey, like Penn and Teller will say, hey, people come and they support we have a career because of people. And it makes me grateful for everyone in the Cashflow Academy. We can't do this without you. And here's the thing. So many more people will be in the Cashflow Academy over the next 10 years, and we're all going to help them together. So your participation in stuff helps us, run it and make it grow and make it bigger. And I think it makes the world a better place. The more people learn how to be financially secure, the better off we're going to be, I think, anyway.
For sure. 100%. It helps everyone if we all are in this together. Steve has a great comment. And I bet you Andy could help you with this. Steve says, Andy, if I make it to Houston, can you please help me with my basketball shot? So,
oh, dude, that's a guarantee. Are you kidding me? I can fix shots like you can't believe. That I can't give many guarantees, Steve. I really can't. But the one thing I can do is shoot the basketball. And the one thing my kids can do is shoot the basketball. We know how to shoot it. Now, whether we can move our feet quick. But I'm not the one that how many of you guys seen Corey's shot winning the state championship? How many have seen the shot? Let's see. Let's take a poll. Who's seen the actual footage of Corey Halliday winning the game-winning shot in the state championship? Who's seen it? I hope everyone's seen it by now, man. We might have to bring that up next week, dude.
Yeah.
You have to showcase that.
I can't believe it. I mean, normally when I meet people, it's the first thing I tell them, and I just show them the video. So I can't believe there's a lot of people that haven't seen it.
Here's the funny thing. We walk on stage. How tall are you, Corey? I don't know how tall you are.
Yeah, 5'8". I claim to be 5'9", but I'm 5'8".
You're a good 5. You're a solid 5'9". Come on, you're a solid 5. So I walk on stage. I'm 6'8", I'm a foot taller than Corey, but he's the one that hit the shot that won the championship. He's the one with a bigger claim to fame than me. I was a farming foul guy at college. They hired me because I could foul. That's it. No, I can shoot the ball. So Steve, the answer is yeah, I can fix your shot, man.
There is a definite difference, though, in that my game-winning shot was high school, which is where my career ended, not surprisingly. Andy's career went on to bigger and better things. For some reason, major colleges were not looking for a 5'8".
They missed the boat, I'm telling you. All right, enough of that. Hey, thanks, everyone. Really fun to hang out. I look forward to this part of the day. And Corey, you said our next one's when?
Tuesday night, Tuesday, March 7th. So
number 8. Don't miss that. So we got a week. Maybe we can have Oxy dive, dude.
We need to. We need
Died.
something to happen to
It happened. Okay, I got a big day
talk
Thursday.
to.
We got a podcast with John Cochran. So that'll be big. We got a big
Very
day
cool.
on Thursday. All right, guys, we'll see you on Thursday. Have an awesome day. Keep your position sizes where they ought to be. Practice in your paper trade account. Don't do anything nutty that's going to get you in trouble. And we'll see you guys next time. Thanks, Corey.
Thank you. Goodbye, everyone. And happy birthday, Irina. Happy birthday.
Happy birthday, Irina. We'll see you.